All right, welcome to all. The way the power break works, for those of you who not attended before, is we spend about half an hour talking about what's going on in the economy, what is going on in the markets, kind of top of mind, if you will. And then we take the last half hour to delve into a special topic of the day. Today, our special topic is Outlook 2025. I did try and fire up my crystal ball. I do have it right here. We'll see what that crystal ball had to say when I got it going earlier this afternoon. All right. First step in the power break is always to ask you for topics. I've done that once now. I'm going to do it again because no one has responded except with your tests. Do you have any topics out there that you have questions on, things you've read about, heard about, your friends have talked about, particularly regarding the economy, observations that you have, anything that you want to talk about? If you don't send me anything, I will have to resort to the boring bullet points I have put together, and no one wants that. So if you have anything you'd love to chat about, please let me lay it on the chat right now. I am gonna obviously have to look over and admit more people as they start showing up. So if I look a little distracted, I apologize. All right, we have a shy group here today. No one's texted me anything or chatted me anything. So I am going to go ahead and oh, here we go. What is the outlook for the Fed rate cuts? We got somebody. All right, somebody wants to talk about the Fed. We can do that. As you know, Fed meets December 18th is their next meeting. At this point, the markets are expecting them to cut rates once again by 0.25%. Although today's inflation numbers, which we'll get to in a moment, it may give that pause. As of this moment, they're anticipating about an 85% chance that the Fed is going to cut those rates one more time this year. What's interesting is how they have repriced the future rate cuts. So earlier this year, many of them were anticipating, maybe 5, 6 rate cuts in 2025. They were thinking the Fed is really going to have to cut those rates to keep the economy afloat. That has changed. At this point, as we look at what bond traders are pricing in, they're pricing in only 2 rate cuts for all of 2025. Perhaps one in March and perhaps one in July. As for the 18th, as I look at my source here, 98.6% chance that the Fed will be cutting rates by 0.25 point on the 18th. Hope that answered your question. If you have more, just throw them out there. Otherwise, I am going to head off into my prepared remarks by sharing my screen. All right, so start with the economic updates that we have here. Obviously, these were prepared for yesterday because I had 2 power breaks yesterday, the in-person ones. This morning, they did release the Consumer Price Index. They were expecting overall inflation to increase from 2.6 to 2.7. Those expectations were met. Excluding food and energy, expecting to remain flat year over year. The Fed has a little bit of a problem. We talked about how the market is expecting them to cut rates on December 18th, but they have a bit of a problem. And I'm going to switch screens here on you. Hopefully you can see the different screen now. So this is just a chart of inflation over the last 12 months. The red line is all items, less food and energy. And again, that seems kind of weird because, we use a lot of food and energy. Why would we not care about that? It's not that we don't care or the Fed doesn't care. It's that the Fed has no control over how much oil comes out of the ground or any control over the weather and what crops look like. So that's why they back out food and energy as they're looking at things. But looking at that over the last 12 months, you can certainly see that we've had a nice little decline here. Persistent, that's exactly what the Fed wants. The Fed wants the inflation to continue on a downward slope. And then we hit August and September and October and November, and that slope has stalled out. And this is much of the reason that the market is now not anticipating as many rate cuts is because inflation is proving stickier than they thought it would be. If we look at all items, so this includes food and energy, you can see over the last 3 months That's not headed in the right direction. So Fed has some challenges in front of it. Throw in possible tariff additions. We'll get into that a little more detail in a second. But you could see inflation take a leg up here, which is exactly what the Fed does not want to happen. So that is the CPI, Consumer Price Index. Keep in mind that is not the inflation index that the Fed uses, or it's not their preferred inflation index, I would say. That is the personal consumption expenditure, PCE price index. That release is not coming until 2 days after their next meeting, so it's not going to do them a lot of good. Just to kind of compare the two, what's the difference between CPI and PCE? In October, year-over-year inflation on the CPI, 2.3. I'm sorry, on PCE was 2.3, and for CPI it was 2.6. So PCE tends to be a little lower just because of the way they construct the index. They assume that consumers replace expensive goods with cheaper goods when they hit a certain point. The Fed feels that is more accurately depicts the inflation picture. You will note that none of these reports are showing up at 2.0%, which the Fed has been stating is its target. We're a ways away from that yet. So the last thing that they want to do, the last thing, now that they think they're at the door, right, knocking, getting that genie back in the bottle, they don't want the genie to get away from them again. So they will be highly motivated to make sure that rates stay high enough to thwart off future inflation. Last Friday, we got in a November employment situation summary. Unemployment up 0.1% from October. Still about 7.1 million people who are unemployed. That remained relatively flat, as did the participation rate, the number of adults who are participating in the workforce at 62.5%. That is after coming back pretty strongly after COVID. So it was down in the around 60 during COVID. That has continued to climb back up, and we've kind of plateaued here at about 62.5% of adults being in active workforce. All right, checking for people to admit, checking the chat. Nobody's chatting with me today. As far as the number of jobs that have been gained this year, I found it interesting. Job gains have primarily come from two different sectors. Number one is healthcare, which has been 41% of job gains this year, and government, which is 21. Put them together, you get 62% of job gains coming from those two specific sectors. Healthcare, the theory is that we're still rebuilding after COVID. COVID was a very rough time for medical professionals. Quite a few of them left. And the healthcare sector is rehiring to restock their employees, if you will. As far as the government goes, that's not federal government. That's primarily local municipal government. Keep in mind they are floating in dollars still from the Inflation Reduction Act, which sent a whole boatload of money out to local municipalities. So they have been a little bit on a hiring spree. Going over to oil, if you look at the price of oil, if you were shopping for a barrel of oil last year around this time, you would find it is almost precisely the same exact price as this year. So oil, well, it went up a little bit last year and then back down. It is back down. One of the ways we keep track of that is looking at the Baker Hughes rig count. The December 6th report came out, showed that there were 589 active oil wells within the United States. Compared to a year ago, that is 37 less. Canada had 194, roughly the same, and international rigs dropped 59 to about 919. Oil has been cheap. You probably noticed this when you gas up your cars, right? Under $3, in some cases under 275. I hope you are enjoying that. You really have one organization to thank for that at this point. That would be China. Their economy is struggling. They are not consuming as much oil as they typically do. The oil they are getting is primarily from Russia at this point, quite frankly. So we have less demand, which is keeping those prices in check. And then final point, which we will go into in a little more detail in our Outlook 2025, is tariffs. Uh, Stated motivation for these tariffs. And again, we don't know if these tariffs are going to be real or if we are just positioning for negotiations to begin at some point. But the motivation ranges from protecting or creating U.S. jobs to motivating more action on reducing illegal immigration. Let me talk today. Uh, Reducing productivity, increasing cost to consumers, reducing cooperation relationships, all negative drawbacks on tariffs. I think that last one is probably underestimated. When you are trading with people and you are relying on them and they are part of your supply chain, you're much less inclined to beat up on them. The world could really use a lot less beating up these days. What's going on in Syria, what's going on in the Middle East, what's going on in Ukraine, just incredibly dangerous, shall we say. We can be thankful that we are not experiencing that kind of conflict in our country, but you really hurt for those people who have been impacted by that for, in some cases, years at this point. So we'll have to see how the tariff threat carries out. All right, I got something on the chat line here. Do you think we'll be drilling more as the new administration takes over, lowering prices further? Great question. From a regulatory standpoint, we do anticipate more transportation options, a la pipelines that were sidetracked under the previous administration are probably going to be reevaluated for moving forward. As far as regulations on drilling, probably less. Whether that leads to more drilling is really a process of how much does it cost to get that oil out of the ground. If companies can do it profitably at current prices, then you should expect activity to pick up. If the cost of getting at the reserves is not profitable at today's prices, you will not. Again, much of that ties back to China, and can they get the wheels on their economy moving faster? Great question. Thank you. I don't even know who that was because they are a letter and numbers. So I would thank you personally, but I don't know who you are. Oh, Joe. Okay. Thank you, Joe. Um, all right. Uh, I'll give you 30 more seconds while I catch a drink of water to send me other things on the economy that you maybe thought about while we were cruising through those. And then if there's nothing, we'll migrate on to the markets. Alrighty. Seeing nothing, we're going to move on to our markets. Our first stop for the markets is always at our monthly stats, as we call them. There is something amazing on this page. Something that I have not seen for, oh golly, it's got to be almost 4 years at this point. So groundbreaking. Hey, piece of paper. Is it a piece of paper if you show it on your screen? Maybe not. Ground-basing piece of information here. Over the last 1 month in orange here, you can see it was a fantastic month for those small cap companies. Russell 2000 is the index we use there, up 11% in 1 month. Now again, they've been lagging for a long time, so they're just kind of catching up. But you can say they trounced those U.S. large companies that have been leading the pack for the last 2 years. International was down in November. You can see that. That was very much a function of the U.S. dollar. U.S. dollar, ding, after the election took off. If you are a U.S. investor and you invest overseas, the profits you make, you have to turn them back into dollars. When you make that conversion, if the dollar goes up, you get fewer dollars. That hurts performance for international. So that is why that was negative for November. And then bonds, 1.1%. Again, rates went down initially. In December, they've gone back up. So December's return is not going to be that favorable in bond world. That's over the last 1 month. Peaking out to 6 months, you can see that small caps have outperformed large caps over the last 6 months. That hasn't happened for a long time. Oh, wait a minute. Don't look away. The green small caps have outperformed large caps over the last 12 months. That is what hasn't happened for 3 or 4 years. We haven't had small caps be the win, 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 win. So that is amazing, let's call it. You can see that on our style boxes here, where over the last 12 months, what used to be a giant disparity. So there used to be 40% difference between large growth and small value. Small value has closed that gap. Growth has struggled a little. We're back to almost equal footing. I mean, within spitting distance for everybody. Especially over the last 3 months, you can see mid growth, small growth have been a fantastic place to be while large value has lagged. Got another question on the chat. I just got to read it here. It has to do with tariffs. Would small caps be an area we might overweight? Is IAG watching this closely and planning their asset allocation models based on how this transpire over the next few months? So the answer to that is we have actually been overweight small caps for about 18 months now. On a relative value basis, they looked far more attractive than the big companies. Now, the big companies took off, absolutely. Small cap companies are now starting to catch up. If tariffs go into place and you have more protectionist policies, that certainly could benefit them. They could increase their earnings. Small caps were anticipating earnings increasing by 25 to 30% next year, which is astounding. That's analysts. That's not IAG. That's just general analysts. And for large caps, it's only 11%. So we do think small caps have an opportunity. We have been over allocated there again for roughly 18 months, maybe a little longer, and anticipate retaining that over allocation in this environment. Again, we are always leaners from an allocation standpoint. We're not going to all jump out of large caps into small caps, even if we think they are fantastic, because, well, the market can prove us wrong faster than we can adapt. So we always want a diversified portfolio, but we will lean into areas that we feel have opportunistic characteristics, and we will lean away from those that we think have more risk than opportunity. Then just looking over the last 10 years, this does tend to mean revert over long periods of time, but you can see large cap US companies have just been where to be over the last 10 years. Again, that says nothing about the next 10 years. If anything, it probably says the opposite is going to be true over the next 10 years. I wish I had this little baby working for me, but I can't get anything out of it. It does not work. It's about ready to fall off my desk though, which would really break it. All right. So those are our market stats. Again, the theme here is what has been a big large cap rally in those magnificent seven, those big tech companies, has broadened out. We have more mid cap stocks participating. We have more small caps. That's a good sign. That's a good foundation to build on. There are certainly reasons for the market to be excited about 2025. They are anticipating good things. We'll get into more details on that in a moment. All right, our next stop is our what we call our market mood meter. I'm going to shrink that a little bit so you can see more of it. So this just tracks what the market is feeling. This isn't how you feel. This isn't how you should be feeling. This is how the market is feeling. And over the last 12 months, you can see it has been consistently decent. Let's call it that. We do have two little tantrums here. One in April, one in August. Both of them were for the same reason. Both of them, the market thought there was a recession coming based on some economic data. That did not turn out. And it's difficult to find much justification that there is an inflation or a recession coming. You can see we had a little bit of I'll call it election jitters event here. After the election, things just took off in terms of optimism in the market. The important thing, and this is always the important thing with the market mood meter, is this little red line is maybe a little faint on your computer screen, but there's a little red line that goes right across here. And when the market is feeling that happy, we always want to make sure that we have the right amount of stock allocation in your portfolio because you may have too much. Market may have gone up. It may be time to trim it back. The happier times, of course, are when we get below this blue line, which you may or not be able to see. And that is when the market is scared, panic-stricken, and defeated. That is when we need to check to make sure you have enough stocks in your portfolio because that is when opportunity presents itself for buying at low prices. Right now, in many of our client meetings, we are going back and just trimming back stocks a little bit. getting it back to the right risk profile, because that is all we control. We control how much risk we are taking to accomplish your goals on an individual basis. We cannot control the economy. We cannot control the markets. We cannot predict the markets. We control risk, assuming that at any day the market may turn against us, even though its long-term trend is up. All right, that's our market mood meter. We are going to move along next to our yield curve. I look back, kind of embarrassing. The last time I talked about a yield curve with you is 15 months ago, and that is clearly a deficiency on my part. We should have been talking about this more. Just as a reminder about what a yield curve shows us, this is U.S. Treasury. So this is only U.S. Treasuries. This is the length of the bond, anywhere from 3 months out to 30 years. Over here, we have the interest rate that investors are receiving on those bonds for that different term. The green line is from a year ago. All right, so here is what that curve looked like. You could get a 3-month treasury for about 5.5, but as you went out, you got less. So that's called the inverted yield curve that you heard so much about. When you are getting paid less for a longer term commitment, that's not right. That's unusual. That's not the way the world should work. That is what had everybody thinking there's a recession coming, and it's still not here. Taking a look at the blue line, that's where we are today. We observe two things. Number one, the 3 months has come down by about 1%. Strangely enough, the Fed has reduced their target interest rate by about 1%. That's because the Fed can influence, if not heavily control, this part of the yield curve. They run the show in this area. But you will notice out here is we are approximately exactly where we were a year ago from a long-term basis. Now, there has been some ups and downs in between. I don't want to make this look like a smooth ride when it's not. But we've arrived at the same destination, where the part of the curve that is controlled by, hey, is the economy going to grow? B, is inflation going to eat our shorts? You know, if we put a $10,000 in a bond, we still get $10,000 in 10 years, and it may not be able to purchase as much because of inflation. So those fears would be expressed here. It also expresses the creditworthiness of the government because, hey, if they're going to pay you $10,000 back in 10 years, doggone it, they better still be around to make good on that. So if we were starting to see concerns about the creditworthiness of the U.S. government, it would start to show up in this realm as well. You can see that we have not achieved a fully normal yield curve yet. A normal yield curve, if the traders are right, you know, by next summer, perhaps this blue line will have dropped down to here about 3.5. Typically, the 10-year treasury trades, call it 1% over the 3-month. So you'd think that this would be up maybe a little bit. But the real action over the next 6 to 9 months is going to be this should continue to fall. That is contingent upon inflation regaining that downward trajectory that it has lost. If it doesn't, the Fed's not going to feel very motivated to cut this end, and we're going to be stuck still in this inverted yield curve unless rates go up. That's the way you don't want a yield curve inversion resolved. So that is our yield curve. All right, next up, we're going to touch on inflation. Oh, we already did that. So I'm going to go back to our words page. All right, I think I've covered most of this. Thank you for Eric for asking about the odds of the rate cuts. We got that. We talked about international. Oh, we didn't talk about the last one there. So as of December 6th, the current, this is a mouthful, next 12-month price to earnings ratio, NTMPE, what does that mean? That means analysts think the S&P companies cumulatively are going to earn this much over the next 12 months. We divide that by its current price, and we come up with the next 12 months PE. Currently, and that tells you how much you are paying for $1 of earnings. So right now, with the NTMPE at 22.35, you are paying $22.35 for $1 of corporate earnings. That is relatively expensive. All right. It has not been this high since April of 2021. Did I mention traders are kind of thrilled and optimistic? It is also well above its long-term average of 18 which we would call normal, I guess. If anybody recognizes normal times, please let me know because I don't know what that looks like anymore. That tells us that stock prices are they're not cheap. The question then becomes, well, if they're not cheap, shouldn't we like move someplace else? And the answer to that is no. Because just because it's at 22.35 does not mean it's not going to be at 25 6 months from now, and we would have missed a lot of appreciation. The key, as always, is to be making sure that you never need to pull money out of the market when it goes down. So any of your cash flow needs, anything that you may use in the next 3 years needs to be safe so that we can tolerate the chance that it goes from 22.35 down to normal at 18, which would mean prices go down. We can't give up the opportunity that it goes to 25, though. Always keep in mind, there is no limit on irrational behavior. And part of that we aim to profit from. All right, got another question here. Oh, two questions. Read a report by Goldman Sachs that said their long-term expected rate of return for S&P is 3% over the next decade. Does IAG share that given the high multiple? No, I guess it would be the short term. I am humble enough not to say what the return is because I believe it is entirely unpredictable. It's great to put 10-year projections, but if you look at the accuracy of the experts over 10 years, it's bunk. We're more focused on making sure your risk is right, knowing that there are going to be bouts of underperformance and they can last for a few years. We need to be able to survive those without selling. So that is our main focus. I wish I could tell you for sure what it's going to be. I can't. I do know that if you give the market 10 years, it will outperform bonds and it should beat inflation. That's about all I can tell you. All right. How do you view proposals we've seen for a mirror act for tariffs or charging other countries what they charge us across the board, level playing field, as it were? Uh, okay, so my inclination on tariffs is they should be done away with. Purely from an economic sense, it creates all sorts of unnecessary friction. It incentivizes protectionist policies and maybe protects industries that should go out of business and keeps them alive. Um, I tend to think tariffs as a net negative, and I understand they raise revenue for the government. I understand why they're popular because they sound great, right? We're going to have, other people pay for our stuff. In reality, that's not really the way the world works. And so my preference would be to decrease tariffs over time instead of mirroring or punishing. And again, the thing is, we don't know really if this is positioning or reality. I mean, if you can imagine slapping a 25% tariff on Mexico and Canada after all those companies rejiggered their supply chains to get stuff away from China that had to come over, and now it's in Canada and Mexico, and now they're going to slap a 25% tariff on that. It's that wouldn't be good, I guess, is the best way to put it. All right. See nobody else to join us and nothing else on the chat. I think we're ready to move along to our topic for today. Exactly at 4:30. Boy, somebody should document that. I haven't made it on time for years. All right. So our special topic for today is 2025 Outlook. We've covered a few topics that may rhyme with what we're going to discuss here. You'll note that the document that I have selected as our basis for our conversation is from T. Rowe Price. There are two strict criteria that I had when selecting this. Number one, it had to be available. I was going to use LPL Research's materials, and they released it exactly half an hour after my presentation began yesterday, so that was out. The second criteria, it has to have pretty pictures. So the graphics here were pretty cool. And the reason I say that kind of facetiously is I like to, take what other people have prepared because it is more beautiful and better than I can do, quite frankly. And then I go down the agree disagree line and say, hey, here's this one thought, but I'm not really on board with that, or I'm on board with that, and just kind of use it as a conversation starter. So that's why we are using T. Rowe Price. 2025 global market outlook as our basis for conversation. Uh, okay, so I've never done this over Zoom before, so I'm hoping you can read the information that I've highlighted. I'm going to try and blow it up a little so you can see it. You'll have to let me know how this goes. Our first stop, and again, I realize that's really small, so we're going to go bigger. I've highlighted the pieces that I'd love to pull out for you. If you'd like a full copy of this, you can send me an email, shines@iagwealthpartners.com, and I can share an entire piece with you so you can read it on your own time. I'm really just going to hit the highlights. I don't think anyone wants to sit through a 27-page presentation where I just read it to you, although I can have a dramatic voice. All right. Item number one, we believe the world is currently undergoing transition at a pace and scale rarely seen before. Progress goes in fits and spurts, right? You think back to the early 90s when the internet started taking off and information could be shared very freely. We are going through that transition again. This time in the version of AI primarily is the illusion there. So it's going to be uncomfortable probably in terms of how quickly AI is rolled out. It can do a lot of positive things and make people more efficient and help them think. It can also replace them from thinking, which is a little bit dangerous. And it can also be used, unfortunately, for a lot of scams, right? So AI can imitate voices, it can imitate images, it can do anything. So it's going to be a little uncomfortable. Change is never comfortable. It's going to be a little more uncomfortable 2025, 2026, 2027 as that continues to gain steam. All right, a couple things to highlight here. Maybe I'll blow it up one more just to hopefully allow you to see it. If anyone can't see it, just let me know and I will blow it up even further. The big picture, global economy is likely headed for growth slowdown in the first few months of 2025 if weaker data from China weigh on the rest of the world. We kind of talked about this already with China having some significant problems. They have a real estate hangover that dwarfs anything that we saw in 06, 07. They have an economy that is not living up to their expectations in terms of GDP, which means people can get unhappy. And if there's one thing the leadership of China does not want, it is unhappy people. So they have challenges. Also, part of, as we mentioned, why the price of oil has remained low is because we're not seeing as much economic activity in China. I am all on board with a growth in 2025. I think that is the most likely scenario, given some of the administration's new policies, particularly in the US, you could see growth. Other areas of the world could be more challenged for growth, but there's very few signs of an imminent recession on the horizon on a global basis, not showing up. All right, next highlighted part. Conditions are changing. As fiscal tailwinds fade, the world is beginning to feel the impact of the rate hikes that have been implemented so far and will continue to do so in the first few months of 2025. There is always the possibility that inflation starts ticking up faster than the Fed is comfortable and they have to raise rates again. That is a risk. That is a risk in 2025 to growth. So we'll have to see. Talked about China. Europe's heavier dependence on manufacturing exports means that China's growth slump will hit it harder than the US. So Europe does a ton of exporting to China. US does not. Obviously, tariffs would decrease that even further. Europe is not talking about adding additional tariffs. We are. And we kind of talked about, are these tariffs real or are they just blustering? It is more likely that China will see additional tariffs than Mexico and Canada, in my opinion. All right, moving along to our next highlighted part. High interest rates mean the ECB, European Central Bank, has the luxury of being able to ease monetary policy rapidly. It has not been good economic news out of Europe. Germany is, shall we say, suboptimal at this point from an economic standpoint. So probably going to need a boost. Once rates come down meaningfully in Europe, the impact on growth is likely to be seen quickly as European households, which have accumulated large amounts of excess savings since the pandemic, are likely to spend more. With some good fortune, the improving outlook for Europe could be further enhanced should there be a thaw in the Russia-Ukraine conflict. Now, that would be a boost gotta let someone in, would be a boost for Europe if we can wind down all the conflict. There is a little bit of a conflict here in and of itself, where T. Rowe Price is saying, Europe may be a good place to be because their economy is going to be growing. The challenge from a U.S. standpoint, as a U.S. investor, is that if Europe does cut its interest rates and the Fed is forced to keep our interest rates higher because of stickier inflation, that means the dollar is going to remain stronger, if not strengthened further. And so, even though it may be an economic opportunity in Europe, unless you hedge the currency out, which most times we don't because it's an expensive proposition, unless you hedge that currency out, you could end up with fantastic gains in euros, convert it back to the US, and you hardly made squat. So, as excited as they are about investing in Europe, we're more neutral, just kind of staying with our static allocation. In fact, one of the things that we may be contemplating at our investment committee in January is thinking about trimming back just a little bit on Europe and switching a little to emerging markets as they have more upside potentially at this point. Even with China's challenges, they may have more upside. We'll see how that goes. We expect monetary easing to have sparked a global economic recovery, albeit inconsistent across regions, characterized by a shift from services to manufacturing. So this is another one of their themes that they are seeing, is that industrials, which have been lagging services for the most part, are going to have a resurgence in 2025. I'm not as excited about that, quite frankly. I think that services will continue to be very strong. If we see a slowdown in the economy, that does not bode well for industrials. If we see massive infrastructure spending, it bodes well. I'm not real confident that that's going to play out. So I will kind of disagree with them on that one. All right, moving right along. And I, again, apologize. This is turning more into a presentation than a conversation at this point because you probably can't type fast enough to keep up with me. I apologize for that. This is a fantastic page, just showing for different regions, economic growth, inflation, monetary policy. I just tried to highlight one or two words in each to just kind of hit the highlights. U.S. outperform. We have been the economic leader in the world for the last 2 years. I don't see that going away anytime soon, particularly not in 2025. Inflation, probably sticking higher than the Fed wants. Again, that could lead to stickier in interest rates being higher, which could dampen growth a little bit, but inflation probably stays higher and the Fed eases less than markets expect. I'm on board with that. Eurozone, tariffs may undermine consumer and business confidence. We'll have to see. Potential for disinflation if tariffs are implemented that lead to excess capacity. Again, disinflation, if you're doing it from a low bar, that's not a good thing. And European inflation has come down quite well. They spent years trying to get some inflation. They finally got some, they got too much. So disinflation, not necessarily horrible, but from the starting point they're at right now, they're not really looking to disinflate. Could see the ECB deliver some rate cuts in order to stoke the economy a little bit. As far as emerging markets, trade wars, possibility with the tariffs with the new administration poses a risk. Latin America is struggling a little bit with the disinflation and may need more cuts if the Fed starts easing. We'll have to see. As far as China goes, structural challenges is what I highlighted. We've talked about that already. I'm not going to go back to that. Inflation is below trend. They'd rather have more inflation in China because of economic activity. It is below where they want it to be, which means you're probably going to get more interest rate cuts trying to spur that economy. They've already taken several smaller steps to try and address some of the issues that they have, and the market has gone, that's nice, you need to do more. That's been the message to China over the last year. That's nice, but you need to do more. And we've seen more incremental policies than boom policies, which is kind of what they've delivered in the past and kind of what the markets are expecting. As far as Japan goes, improving wages should be supportive for consumption and economic growth. That's something they really need. They are in a demographic hole, shall we say. They have been begging for inflation for years, and it showed up, and now it's kind of falling below their target again. But despite that, they still could do an interest rate hike. That's more from a currency standpoint. They have been devaluing their currency rather significantly. Rate hikes would bring that back up a little bit. So that's kind of around the world, if you will. Next up, looking at the US a little closer, we've talked about strength. We expect growth to continue. Job creation probably slows. Again, some of that is going to be due to AI dislocation, as I don't view the AI impact on the workforce as being suddenly. It's much more likely to be, oh, that person went to another job and we're not going to replace them because we have gained efficiencies where we can accomplish the same amount of work with fewer people. That's the way I'm envisioning it. May not go that way, but I don't see it as a mass layoff from AI. Notable increase in productivity growth in recent quarters should support robust wage gains. Again, productivity growth is good for wages. It is good for earnings. The more you can do with less people, the better economically. The challenge is you need less people. So if you need less people and that unemployment rate starts creeping up, that starts to impact consumer confidence. And you don't sell as much stuff or take as many trips or do as many things, and you end up uh, heading toward an economic slowdown or even a recession. Again, not seeing any evidence of that in 2025. Uh, we've seen kind of a pickup in credit card delinquencies. God bless the consumer. They added another, $10 billion to their credit card debt last month. Way to go, guys. So they're not slowing down. We are seeing a pickup in delinquencies on credit cards. We are seeing some pickup in delinquencies in auto loans, just around the fringes. Nothing is saying, recession coming. No flashing lights at this point. Raising existing tariffs and/or imposing additional levies on imports could cause a one-off price shock. Again, that's kind of a one and done. What are companies doing to prepare for that possibility? They are importing things like you would not believe at this point. Stocking up on everything they can, get their inventory up, perhaps even proactively raising rates a little bit just in case that happens. So instead of bigging one big boost, they can spread out those increases over several different periods to hopefully not make their customers or consumers upset. Do keep in mind, you may not remember this, but do keep in mind there was a longshoreman strike just before the election that conveniently was postponed until early 2025 for some reason. If they go back on strike, you could see supply chain, crumble again, at least temporarily until it's resolved. Tough stance on tariffs could result in a negative shock to the supply of workers, tightening U.S. labor markets. So unemployment may go down. Productivity, a lot of things in place to drive productivity. I'm sure if you've gone to a fast food restaurant, you've noticed there are fewer people around. Used to be, 3 people behind the counter taking orders, all sorts of people in the back. At this point, a lot of the stuff is drive-through driven, or there's a kiosk, and there may be where there used to be 7, 8, 9, 10 people, there are now 3, 4. That's called productivity gain. Unfortunately, that also means a lot fewer entry-level positions for people to gain experience. All right, moving on to international and particularly small caps. We expect there to be more evidence of a broadening opportunity set that favors international stock markets. Again, I'm not as excited as he is. Of course, he is the head of international equity, so if he's not excited about international equity, I'm not sure what they would do to him. But I'm not as excited about international in 2025 because of some of the economic and potential currency challenges that they face. We're more neutral. However, I do agree with them from a this statement. Many investor portfolios are heavily exposed to U.S. equities, while virtually every sector in non-U.S. equities is currently cheaper than its U.S. equivalent. That is absolutely correct. If you look at technology, if you look at industrials, if you look at anything, you can buy the same amount of earnings much cheaper in a global company that's not headquartered in the United States. And keep in mind, many of the big companies that you think about, the Coca-Colas, the Pepsis, the Microsofts, a lot of their revenue comes from overseas and emerging markets. Um, but I'm not as excited. Again, we're more neutral. We expect the period ahead to be marked by a higher trend level of demand for tangible assets, supporting sectors such as industrials, energy, and materials, which are typically value oriented. Um, we will have to see how that pans out. Relies somewhat on China getting its footing, relies on continued growth in the United States, relies on Europe doing rate cuts and getting more economic growth there. If none of those occur, this will not happen. All right. History shows that the following periods of earnings decline, earnings growth for small caps have typically exceeded large caps. We kind of talked about that in the monthly stats, where earnings expectations, at least analyst expectations for small caps, is in the 25 to 30 range, whereas large caps are 11. I agree with him here in terms of small caps being an opportunity set. We've already talked about that, so I'm going to move on. All right, here's another bold statement. Who had that question? Joe had the question on Goldman Sachs. Stretched valuations suggest that U.S. stocks will underperform bonds in the medium term. Also, kind of pessimistic on U.S. stocks because of their high valuations at this point. The important thing to note here is that nowhere, and I checked all the footnotes, I checked everything, nowhere do they define medium term, which means they will be right. So they can always claim that whatever happened was in the medium term. That is one of the key things about using one of these is to always make sure that you have no timeline on your predictions because you will be right to improve accuracy. I'm not as pessimistic about U.S. stocks at this point. We are essentially have a neutral allocation to them, leaning slightly towards small caps, as I mentioned, uh, out of large caps. Small caps do have a little bit more room to grow, we think, based on the earnings that are coming. So not panicking there by any stretch. Of course, you should never panic out of the market. It's a horrible idea. That means people are taking advantage of you. Small caps, which are trading at a historic discount to large cap, should benefit from further rate cuts and any signs of an improving economy. They may also benefit from tariffs. So I'm on board with that. Overall, we anticipate a continued expansion of investable opportunities, uh, i.e., not so concentrated in large cap US companies. Sorry about that. Characterized by historically attractive valuations in certain sectors, and normalization of fundamental trends, not sure what that means, and improvement in growth aided by lower interest rates and fiscal support. That's particularly in Europe and China. US again may not see as much, may not see interest rates as low as had earlier been anticipated. All right, moving on to another topic, credit spreads. I look back and I'm not sure I've ever mentioned credit spreads in a power break, so I thought, what the heck? Why not go for it? So if you'll recall back on our yield curve, which I'm going to put on the screen here, these are US Treasury yields. What is the default risk on a US government bond, you ask? Well, right now, it's considered zero. All right, so as far as risks go, the market will tell you that there is no default risk on a US government bond. Now, keep in mind, I'm not sure that's true, but that's the assumption. When you purchase a bond that is issued by a corporation, you will have to pay more than the government because there is a chance of default on a corporation, no matter how solid it is, it's AAA, whatever, it will never be as foolproof as a U.S. Treasury bond, at least in current markets. So on top of this yield, which is kind of the base, you add, if you're a pretty highly rated company, maybe you end up here a little higher. If you're a little iffy, maybe you end up here. If you're could go out of business in 5 years, you may end up here, right? Because investors want to get their money back as soon as possible. If they're going to invest money, their idea is to make a profit and not just get caught holding a bond that didn't pay you any interest and then was worthless in the end. You'll get paid much more interest. So credit spreads, as we talk about them, mean that difference between the federal government interest rate and the credit that's on top of that. Right now, not only are stocks uh, valued very highly at that 22.35 next 12-month PE. Credit spreads are very tight, which means that credit bonds are also priced to perfection, if you will. There's no assumption of defaults increasing. There's no assumption that companies are going to have any problems servicing their debt and or paying it back in 15 years. The market clearly says that it does not foresee a global recession in the next 12 months. Very clear with credit spreads, very clear with the NTM PE. So that is what credit spreads are about. Keep in mind, if we start to see an increase in defaults, and we do see those credit spreads pick up, that means the interest rate on those bonds is going higher and higher. As interest rates go up, bond prices go down. So that's how you can lose money, particularly on junk bonds, lower rated bonds. That can happen very quickly. All right, done with credit spreads. Next up, global growth could surprise on the upside. In this scenario, markets would likely price in rate hikes to battle inflation, resulting in a steeper yield curve. We talked about how that would go as intermediate and longer term yields move higher. So if the Fed does not move the short end of the curve lower, the long end may go up. We've talked about that risk. All right, this is an interesting one. I'm gonna shrink that a little so you can see more of it. So this is where different countries are in their interest rate cycle. All right. Right here in this box, we just started cutting rates. All right. We think they're too high, just started reducing them. You can see the United States is in here, along with many other countries, United Kingdom, Eurozone, New Zealand, Canada, all here. Those that have been easing and are maybe close to the bottom, China maybe has a little more to go, as we discussed. I don't want to call them small countries, but from a global GDP, they're not going to impact the world. Those that have started hiking, Brazil, Japan, we talked about that a little bit. Those that are approaching the end of their hiking cycle, here you find Russia, Turkey, Malaysia, and even Australia. Everybody's kind of concentrated in this start of easing. If inflation does not go down, we're going to accelerate quickly through here to here. And in a worst case scenario, we start here again. So the goal is to stay in this easing cycle on a measured pace as long as unemployment doesn't tick up too high and inflation remains, hopefully, or regains the trajectory that the Fed wants it to be on. Our goal is to be here for quite some time for the United States. I think that's the greatest risk in 2025 is that inflation does not resolve itself as the Fed expects. All right, moving right along. All right, the next few pages here are what I feel are advertisements for mutual funds that they offer. There are that actually is fascinating to read about the GLP-1s. Those are the new drugs that are FDA approved for, controlling insulin, weight loss. It's actually a fascinating read if you want to read it. I'm going to focus more on AI at this point. Parallels are often drawn between the dot-com bubble and the recent surge in AI, but we believe there are important differences between the two, and there are. Cisco, one of the biggest names back in the tech rec, its PE capped out at 125. 125. So you were paying $125 for $1 of Cisco's earnings. That is the definition of stretched, shall we say. Keep in mind, S&P 500 current PE is 22. It was 100 more than that. By contrast, if you look at Nvidia, which is kind of the darling over the last 2-3 years, up substantially, its NTMPE at the end of October was 35. Now, is that high? It certainly is higher than 22. It is high from a historical standpoint, but it is also backed by earnings. The company is actually making money. Matter of fact, people are begging them for their product and paying through the nose. Their profit margins are, what did I read? I think on one of their chips, their profit margin is about 80%. So it costs 20% to make it, and 80% is profits. They are printing money at this point because they have no competition and their product is in high demand. 35 is still stretched, I'll grant you that, but it's not 125. So is there room for moving sideways or even taking a bit of a correction? There is, but it's not to the extreme where collapse is like it's got to happen at some point. All right. Rather than seeing AI as a bubble that is about to burst, we regard it as a multi-year investment cycle in which the initial period of incredibly rapid growth is now giving way to a period of moderating yet still impressive growth. So we've gone from initial adoptees to approaching the mass adoptee for AI. I mean, you saw that in the uptake rate for ChatGPT or anything like that. I don't know how many people use it in their daily lives at this point, but they probably interact with it more in the future as companies default to that as a service model where AI is going to help you solve issues. All right, it is 4:58. That is where I was going to end, which means we have a whole 2 minutes where you can either sit and stare at me, or you can send me something on the chat, or you can sign off. I want to thank you for joining us today. It's been a pleasure talking to you. I wish I could talk with you, quite honestly. In person is more fun, but I understand there's distances and schedules to follow. If you would like to keep up on what we're thinking on a weekly basis, we do send out a weekly blog that comes out on Wednesdays, posted on social media, can land in your email box. If you'd like to do that, just send me an email. I will sign you up for that. Our next power break is scheduled for March at some time. I honestly didn't look up the date. That's so far away, but hope to see you then. Seeing nothing on the chat, I am going to give you 1 additional minute in your day. You can thank me later. We'll consider the power break closed. Have an awesome rest of the day. Have a very blessed Christmas, and God willing, see you in the new year. You take care. Bye now.